Welcome everyone. I see that we have people still arriving, so we wait for a brief minute. We'll come back to this chart later, just to show you under the FX Street Rates and Chart section. We have this charting platform where you can save and load your workspaces. You can download configurations, and you can add, besides all the standard indicators, there are some tools, FX Street tools. For instance, you have the current trading positions. You can plot it on the chart, and you see where the supply and demand areas are for each asset. For those assets, we currently have trading positions from dedicated contributors. Green lines mean buy positions, red lines mean sell positions, and layered on the price scale, so you can identify those support and resistance areas through the distribution of those orders. Okay. You can also plot the news on the chart. Check here. You can plot the news. It's a bit slow on my side because I have the webinar platform, but it should work fine on your side. Here you have today's news. We are on a daily chart here. Pardon. We are on a daily chart, so maybe we switch here to an intraday, 60-minute, let's say. We would see the news distributed along the last 2 days. There are a lot of news coming on a 24-hour basis, so it's why it seems a bit accumulated here on the right edge of the chart, but it should be seen as distributed throughout the day if we zoom in into a 1 hour chart. Like I said, it's a bit slow on my side because of the webinar platform. If we don't jump time frames here, I would start with a session. We have five attendees on the room. Pretty good. We might start. It's fine. Sound fine? Please come. Do you hear me well? I'm asked to increase volume. I believe it's on its maximum. Okay, fine. See, in the previous sessions, I don't know how many of you have been in the previous webinars where we discussed our trading methodology or our trading system, but they were more generic sessions where we talked about the many aspects which make this approach quite unique and also quite specialized. And we try to explain how we arrived to what we are doing today, all the testing, the hypothesis, verification, testing, and also the application, the implementation in a real account, which started in 2015 by March. So we have two years of track record. And we discussed the method from different angles. We went through the statistics. We went through the particularities of the method so that you could understand more or less what it was about. Because still, we needed a couple or three sessions to cover that part, to introduce the method, since in many aspects the method differs from many others. Okay, I will not go back into this approach today in today's session, nor in the in the next session. These two sessions will be more specialized. Okay, in these two sessions, we will deal with a tiny part of the method, but a crucial one, in order for you to start implementing these different approaches or these different aspects into your trading. It's not about copying exactly what I'm doing here, but to extract those parts of the method which you might be or feel identified with, yes, and finally adapt them to what you are doing. Today specifically, we are going to deal with a calculation. It's a very simple calculation. Okay. What we are going to do is a calculation of the average rate of each position. As you know from previous sessions, if you have been listening to these sessions, if not, they are recorded. You can go back anytime and watch them. But one of the key aspects of this method is the fact that you have at every moment, you have many trades contributing to one single position. You have many long trades, many short trades, and altogether, they build an entire position. They build a long position, a short position, and finally you have a net positioning, which is the result of all those orders. This is for us mandatory to operate this way, not to go with one single trade in and out of the market, because we don't want to be exposed to the conventional metrics of trading system valuation, which is drawdown or drawdown recovery, or even considering risk-reward ratios per trade. Instead, we thought, let's go in the market. Let's stay in the market always. Yeah, we are always in the market with many trades, with many long trades, many short trades. These trades, at a certain point, they may hedge themselves out. You may be equally long, equally short, but most of the time, and in order to profit from market movements, you will be not in a 100% balance. Okay. So let's go back on the chart here. By the way, I will share with you a link. This link enables you to plot this same chart on your screen if you wish. Okay. If you click on this link, this is one of the features of the charting platform. You can save this configuration, yeah, and you might work with it later on. In this configuration, you see several lines. Most of the lines here are of technical nature, means we have a down-sloping mega channel here. We have smaller channels inside the bigger channel here in gray color. We have a support line recently drawn here in yellow. We have a dashed blue line, which is the median or the center of that descending channel. And then we have two other lines, one in dashed green, another dashed red. And these two lines represent the average long price and the average short price for my current positioning, my current exposure. Okay. So in order to calculate those lines, you may have inbuilt in your trading platform a similar mechanism. In any case, it's useful to know how to calculate this average, the average price of a position, in order then to combine this knowledge about the positioning with the market structure. Because as I said just earlier, with this method, you will be not always 100% hedged. It's what's more, if you can be this balanced in your exposure, favoring always the market direction, then you will be making more profits, obviously. If you are 100% hedged and the market moves up and down, what you lose on one side, you will gain on the other. So you are, at the end of the day, you are flat. This means in order to profit from market movement, you have to play with the hedge and discharge some of or unload some of the trades on one side or load more exposure on the other in order to create an imbalance between the long and the short position, favoring the market direction. And the market direction you decide by structure. And this is just one example of one possible structure for the euro dollar right now, one that I will use to manage my exposure. I can start by analyzing the big picture. I can start analyzing this big downward sloping channel and saying, while above the median line of the channel, while above this dashed blue line on the upper channel half, I may be net long positioned, and while incurring and quoting in the inferior half of the channel, I will choose to be net short in my positioning. Okay. I can have a finer structure inbuilt into this one, made of smaller channels, which I will use to refine or fine-tune this positioning. So while inside this area here, where we touch the bottom of the channel and slowly build an upward sloping channel inside the blue one, I was preferring a long exposure, and by the drop out of this channel, I looked for a projection of this channel down, and I may have chosen to unload this long exposure and convert it into a short exposure, especially under the median, the central mega channel line. Okay. Once we broke up above this median line again, and inside this potential channel projection which we have here, again, I might increase my long exposure. So that was, if you follow the activity from, I believe, from the previous webinars, we were within this incipient move here up, and I was strongly capitalizing on a move between 0.7 and 0.9, especially 0.8, 0.9, where I calculated if we can go up from here to there, like 100 to 100 pip. I want to be balanced to the long side, more long exposed than short exposed, until we reach 0.9. And if we can continue up to 0.10 or 11 to the top of the channel, I would have increased even more this long exposure. Since we dropped to the channels, the intermediate channel support, my hedge right now is again almost 100%. Yeah, we are again closer to the median, to the channel median line. Yeah. Here, just perched on that support of the intermediate channel. So right now, slightly long positioned, since we are above the median line of the channel, but still not having the same exposure, the same long exposure as we had before. Okay, this is just an example how you will combine exposure with structure, and with structure you can use anyone. I've shared the above link with you, which you can use as a possible structure for the euro-dollar. But for structure, you can use different methodologies. You can combine support and resistance. You can check for Elliott waves. Let me provide you here a very interesting resource. At FX Street, we classify the content in editorial pages, and here you have one just dedicated to Elliott wave analysis, where you have the most recent reports and analysis based on Elliott wave. This is also a great resource in order to find a structure. Let's see. If you are interested in the euro-dollar, we may check the recent material on that and check for the structures which are being proposed here. Okay, kind of ABC corrective wave, which could bring us to the 0.85 area again. Yeah, with a small charting pattern here. You may choose this structure as well in order to play with your hedge. Let's say if price enables to close above this basing triangular shape here, then I will increase my long exposure, for example, up to one of the levels here of the B wave projection, let's say. Okay, so there are a myriad of ways which you might use to decide in which direction to expose your account. In any case, the difference here is that you are not capitalizing on a market movement with one single position, or one single trade, pardon, but with a position made of several trades. Okay, and if you are eventually wrong on your analysis, or wrong on the magnitude of movement which you intended to capitalize on, then that is less damaging for your account if you were just in the market with one single trade. Yeah, if with one single trade, if you are wrong, you close that single trade, you increase your drawdown based on the liquidation of a loss. In this case, if you have several positions open and you play with that by opening, closing the positions, by increasing, decreasing exposure, if within the evolution of the price structure you change your mind in terms of structure, in terms of market direction or trend direction or trend strength, you still have more room to play. You are not forced to close those positions which intended to capitalize on your previous idea, but you can most of the times hedge those positions with others in the opposite direction and let those positions open and reach their profits in a different scenario, in a future scenario which you don't know yet. Okay. Mauricio asks, can I see the daily Elliott wave analysis chart on that page? I'm going back to the previous page. You can see the time frames, which you will see are the time frames which the different contributors provide. Let's see, if you let's say on the euro dollar, if you stay on the euro dollar, let's look for the last euro dollar. Here we have one from 2 days ago. Yeah, let's open that one and see if we have a daily. Yeah, here we have a daily one. Okay, a daily structure. Oh, a daily structure. Yeah, which the contributor is proposing. Yeah, where we just finished a fourth wave corrective pattern. We see this overlapping nature of this three wave movement, typical of a correction, labeled as wave 4. So we still have a wave 5 of 5 on 2 degrees. Yeah, we have wave 4 of the bigger degree here, just finishing here, and wave 5 is still yet to come. Wave 5 would be an impulsive one, so different in nature than the corrective one we have just seen, and similar to the impulsive wave 3, which we had here, which brought us to from 112, 130 to the new lows here of 104. Okay, similar in nature to that. This is the daily picture, which we, in our case, we can recognize the structure here. We would have our channel more or less here. Yeah. Let me see if I can capture. I can capture this one. Okay, and so I believe the structure that we were seeing on the chart before, on my chart, was this one, something like this, I believe, something like this, where we have the median line here. No, it's not that one. Or perhaps, yeah, because we already have part of that movement. Maybe. You see, you can import, let's say, from other analysts their structures and build upon them. Okay. Mm-hmm. Can I please scroll up the chart above that? Above, this is the 4 hour. Okay. All these you can check. Let me provide you the link to the topic page. Here you have. Okay. You can bookmark the page. This is a 4 hour. Okay, we have this different channel. It was written 2 days ago. We were quoting 0675. Yeah, more or less where we are now. So this is again is forecasting a retracement, in this case to the 0750. The other one was to 0850 area before continuing a down move. So you may take into consideration. Okay, so let's now go back to our to the calculation, which is we intended to do in this session. Okay, right now we you have the chart, you have the structure, and you have this plotted here, our average positioning levels, okay? The average long price, and which is right now is at 10762, and the average sell price, which is it's at 0618. Means in between those levels, I'm negative, I have a negative float for both legs. Yeah, I will be making money if the market recovers above the green line. I'll be making money on the long position, and if the market drops between the red dashed line, I'll be making money on the short position. Let's let's go here into a blank page, and I will explain you. Let's start with a fictional case. Okay. Let's say we have a purchase of euro. Okay. We bought euro dollar, 2 mini lots at 0.6. Okay. We bought the 2 mini lots at 0.6. So I have a negative dollar exposure here of $2,120. Okay, 2 mini lots. This is the equivalent of 2,000 euro. Okay, at 0.6, this means $2,120. Okay, so a purchase, a long trade on euro dollar. Okay, but 2 mini lots at 0.6, my dollar exposure is a negative 2,120. Okay, let's say I do another purchase of 2 mini lots at 0.750. Okay, again, 2 mini lots euro. It's the base currency, so 2,000 euro at 0.750. The equivalent in dollar, since I'm going long euro, I'm short dollar. Okay, 2,150 at this price. Okay. So all in all, I'll be having a long position. I'll be having a long position of $4,270. Yeah, that would be my exposure on the long positions. Now, what I'm looking at is, I know I'm long 4 mini lots euro, but I don't know at which price I am long. What is the average? Yeah, what is the average rate? The one which I will be plotting here on the chart to know what is my break-even level. Okay, what is my break-even level for that positioning? Okay, and this is pretty simple. The average rate is calculated simply by, I take my dollar exposure. Okay, since remember the euro dollar is the euro is the base currency, the dollar is the quote currency. Okay, so I'm quoting in. So the price scale is in dollar. So I take that dollar amount, which is my exposure, and I divide it by the quantity of lots which I purchase in the market in this case. Yeah, so 4,000 4 mini lot. Okay, divided by 4 mini lot euro. Okay, this is euro. Okay, and this is USD. Okay, and I come up with a figure, yeah, and that figure means I am long euro 4 mini lot at 0.675. 10675 is my average long position. Okay, it's that simple. most platforms will calculate this, or many, and if not, there are surely plugins or personal indicators which built on the platform which will calculate this. This is just to show you what the platform does, and this is what an interbank dealer would do on a day-to-day basis in order to calculate its exposure. We have done here the example for the long exposure, but the same would be done for the short exposure. Say I have a sale again, 2 mini lot at 105, okay, translated in dollar. Since I am short euro, the exposure is long, so I put here plus long dollar, $2,100 long exposure, yeah. And if I enter another trade and sell it this time 3 mini lots of euro, yeah, 3,000, okay, 3,000 euro at 0.420, okay, in dollar, this translates to 3,126. Okay, this is simple math in the sense that what I'm doing here, yeah, what I'm doing here is simply taking the quote. I'm taking the quote here, 0.420, okay, and I'm multiplying it by 3 mini lots, okay, and I get the dollar amount for that short euro, okay. So far, is it clear? Is it clear how we proceed to here? Because it will be very simple going forward. But it's important that this simple math that it is well understood. So if there's any point which is not clear, don't be afraid to ask, okay? And we go back. Yeah. Okay, so we would do the same as above with our long positioning, and we would calculate at which average rate we are short. So our short positioning in this case, we are short 5 mini lots, okay, 5,000 euro. We have 2 mini lots here, 3 here. We are just summing up, yeah, 5 mini lots at, and this is the price we are going to calculate. We just have here the long dollar exposure, long because we are short euro, okay? Long dollar, 5,226, okay? And the average rate would be taking the long dollar exposure and divide it by the quantity of lots which I shorted the market in euro. Okay, and this gives me an average rate, the average short rate, which I would go back to the chart, yeah, and I would plot here. This is what represent this line here, yeah, my average short rate. It does not correspond to the same price because these are the real ones. I have built into this position. I believe right now, yeah, we have 11,000 euro on the sell and 12,000 on the buy line. Okay, but it's the same calculation. I'm just using here an example, a simpler example where I'm just entering 2 positions here, but 2 trades. But the list could go on and on. If you have 10 trades, you do the same calculation for the 10 trades, yeah, and the same calculation will give finally the average rate. Okay. Okay. So this is basically it. So right now, what can I take from this calculation? First, I can know what is the break-even rate for each leg. Okay, I know that above 0.675, I'm making money on the buy leg, and below 0.452, I'm making money on the sell leg. Okay. In between, I'll be losing. If the market is in between those both figures, if it quotes, let's say at 105, yeah, I'll be losing on both sides. Okay. If I go above 0.6, I'm still losing on the short because I'm short from 0.4. At 0.6 and above, I'll be obviously still losing on the short side, but I would start making money on the long side. Yeah, this number on your trading platform would switch to green, which is our preferred color as traders. Okay, so I repeat. First, it helps me in calculating this average or break-even rate. I know this is the rate where I would be break-even for each leg separately. And second, I can square off the positions. Yeah, I can square off the positions knowing what I need to do to square off and be equal, or I can calculate an average rate which includes all purchases and sales in a weighted average. And in fact, this is a weighted average which I have here, because as you saw in this example, I'm calculating these rates together with the amount of lots which I'm entering, with the size of each trade, which I'm entering the market. So finally, this average is not only an average price, but a weighted average, because I can go and make this calculation, which would be wrong for our purposes, and take the entry levels, and average them, and that would be wrong, unless the exposure for each level will be equal. Yeah? But if not, then I need to calculate a weighted average. And this calculation, this simple calculation, which is really not difficult to do, is a weighted average. Yeah? It will take into consideration if you enter at a certain level, you enter a bigger or a smaller position, it will take that into account. And this price level here, this average rate, is not only an average, a price average, but it's a weighted average accordingly to your exposure at each one of these levels. Okay, so far, so well. Are you following it to this point? So this is important for me to check, because we are about to finish. There is just one little calculation to add to it, but it's not different from this one. But it's important that this one is understood. Yeah, just if there is no question, I believe that everything is understood. Okay. Okay, all clear. Excellent, Adam. It will be even more clear in the end, where we see why we need all this. Yeah, for sure, this is something that many platforms calculate by themselves. You have them calculated through a broker. This is what the broker does. Is the same calculation, but knowing how to reach these numbers can give you an edge. And this is something, believe me, nobody is doing this. Nobody is doing this exercise. You can ask experts. Yeah, and believe me, most of the people would average the price only by taking the price, not doing a weighted average. Yeah, so they would have no idea really at what level they would be break even. Yeah, First, most people don't need it because they go in and out with one single trade. And if we have just one single trade, there is no average to calculate. But as we saw in previous sessions, there is a huge advantage of breaking the position in smaller trades and having trades across the price scale, so that you can play with. And this is part of this money management. And knowing how to calculate this gives you an edge. Why? And this is what you're going to see now. Let's take now and take the long position from above. Yeah, this long position of 4 mini lots at 0.675. Okay, I take it is from here. Okay, let's put it here so that we. Okay, so that we are identified. It comes from here. Okay, and we have also a short position, which we already averaged. Yeah, the short position, and this one comes. And this one comes from here. Oops. Okay, so I'm putting these two together. Okay, long euro 4 mini lots at 0.675. So long euro means short, negative, yeah, negative dollar, and this is the amount which I calculated. And on the short side, I'm short euro. Euro is the base currency, euro dollar. Base currency short means I'm long the quoting currency plus here, yeah, plus 5,226. Okay, and this provides me a figure which we will call the net position. Let me put it a little bit smaller so that we can see all in one screen. Okay, and here we have, this is the net position. This is the net position. Since I am more short than long, I have 5 mini lots short than long, I am short, net short, or in dealer language would say oversold. Okay, I am oversold 1 mini lot at, and this is the same calculation we did above. The same calculation we did above. We take the net exposure in dollar, yeah, the net exposure in dollar, and we divide it by the net short, or the net position, in this case, short 1 mini lot. Okay, I'm long 4, short 5, the difference is 1 mini lot short, so I'm divided the $956 by 1,000 euro, yeah, and I'm getting this figure here. Okay, I'm getting this figure. This figure 0.9560 is the exchange rate, yeah, below parity, yeah, where I would be break even on both positionings. That is, if I maintain the same positioning as I have now, yeah, with the same positioning as I have now, I'm not saying here where we are quoting. Yeah, I'm not saying here where we are quoting. This is independent from that. But I know that at 0.95660, I would be break even. And that is easy to understand because I'm more short than long. That means if the market goes down to parity and below and reaches 0.9560, I'll be making more money in the short position than I would be losing in the long one. And that is the key. That is one of the key to understand. Because of this imbalance between both exposures, Yeah, I am net short. This is the same. This is the same as I would enter the market only with a short position of $956. Yeah. Or in that case, yes, long dollar, but the correspondent short with one single trade. Yeah, yeah. So you may choose if you say, okay, my target is parity and below. My target is 9.5 or whatever. Yeah, I can choose and put one single position, and you bet on the market with one single position. Yeah? But in this case, you know that by reaching this price, yeah, you would be break even, and from there, below you would entering into gains. But you are giving the market a little more room, yeah, because if before going to 0.56, before reaching that level, what if the market goes above 0.675 and you start making money on the long side? Yeah, you may decide, if you reach a top, you may decide at that level, yeah, to cash some of these positions. You would cash in, let's say, from those 4 mini lots, you would close 2 or 1. Yeah, you would cash in, yeah, and at that moment you would be even more net short because you would still be short 5 mini lots, but you would be long, let's say, 2 mini lots. From that moment on, you would be net short 3 mini lots. So by being net short 3 mini lots, your average rate, your break-even rate would be increased probably, yeah, because you would not be dragging those long positions with you. You would have closed them in profit, yeah, and from there on, you would be with a net short position of 3 mini lots instead of 1. You see the point where you can play with it, and that is a combination of this simple money management, of this position sizing, together with market structure. I may say, if the market shoots up towards the upper side of the channel, but I still believe that from my analysis that in the long term will be down to the channel bottom, I can establish such a strategy where I don't close those short trades, yeah, during all this way up to the channel resistance, yeah. And here I would close my longs, for example, which I have from below the lower half of the channel. I would cash them in here. Yeah, I would be very imbalanced here, of course, and I would say I would only close my short if we shoot above the channel. Let's say, just an example, we shoot above the example, and I forget my short positioning. I close them out. I've made enough money going long, which I will use to compensate the shorts in the loss. Okay, so it's more of a matter. You become more a money manager than only a trader focused on timing the market, because timing is our weakness. You may say, I believe the market is going to parity or whatever, but you don't know when. And you can construct with time, you can construct a short position aiming to go to parity and below. But in meanwhile, and this meanwhile can be 6 months, 1 year, 2 years, 3 years, you don't know. In meanwhile, you would be making money also on long positioning. yeah, on both sides. So you could be very short-term oriented and very long-term oriented, both in one same strategy. But the timing will be not your issue. The timing, the market will give. The market will reach those levels when it is ready, and you don't include that as an edge in your trade. You don't need that timing. You just need to follow the positions and to respect the structure and make decisions where to average or where to hedge or unhedge based on the structure. Yeah, but the timing issue would be not as needed as in a trading system where you go in, all out. Yeah. So when reaching this point where we have an average rate for the position, I find out three things. One, I can calculate the profit and loss on a mark-to-market basis, yeah, for the positions which are not closed at the end of the day. Okay, for us this is not at all interesting because this is something the broker does. I can see all the time what is my profit and loss. It's calculated on a real-time basis, but this is the way profit and loss is calculated. It's how your broker calculates your profit and loss, or your platform. Okay. Second and third, these are the what we are interested at. Second, I can know at what rate I would be break even with the current exposure. If I don't change the exposure, I know I would be break even at 0.09560. Yeah. And third, I know what is my net exposure, so I can calculate how much I make per pip movement. Yeah. So if the euro dollar moves away from 0.9560, if it moves up away, the drawdown intensifies because I'm net short. If the exchange rate, on the other hand, approaches that level, the market goes down, the drawdown decreases. Yeah? And if the rate moves below 0.560, the position starts making money. It goes into the green, our preferred color as traders. Okay, so, and at that point, I would leave the current session because this is the point where we will continue in the next session, where we will talk about the position, the pip calculation, the value of a pip. Yeah, and just as a means to wrap up the situation and to go back to our real positioning in our trading right now. Right now, we are long at this level, long 12,000 euro, in short 11,000, pardon, 11,000 at this level here, at 0.680 weighted average, and at long at 0.762. Okay, so I am net long one micro lot, net long 1,000 euro, one micro lot. What does it mean? That each time the market moves one pip, yeah, each time the market moves one pip, I make or I lose 0.09 euro, 9 cents. And why is this important? Because if I am net short, I may say, okay, let's say the market drops from 0.660 or 0.7 to 0.6. Let's say it drops 100 points. Yeah, 100 points would take us to the center line of the channel. Okay, I don't want to change this exposure a lot if we stay within these levels. But I would like to remain net short 1 micro lot. Yeah. So I would be making €9 on the drop. On that drop, because I'm net short 1 micro lot, I will be making €9. Okay. And that is the one of the nice things of calculating your net positioning. You can calculate within the imbalance between long and short exposure. You can calculate how much is a pip worth, and start making scenarios. If the market goes up from here, how much I will be gaining or losing? Yeah, because in the end, you have like we have right now. We are in between those lines, means both positions, both the long and the short position, I am losing on both. So the drawdown, the floating drawdown, is made of both sides. Okay, the long side a little bit more because we are a little bit more far from the average long than average short. Okay, this means I can start inferring with the help of the structure, yeah, if I would be increasing my drawdown or decreasing the drawdown, the floating drawdown. And the floating drawdown finally impacts my equity, right? The equity, which is the balance, the account balance, minus plus open trades. Yeah, since the floating right now is negative, yeah, I have an equity which is below the account balance. Okay, but this equity will go up and down, yeah, depending on the market movement, because I am slightly net short. So if it goes down, the equity will make a little more money. Yeah, the drawdown will be reduced a little bit. Okay? And that is the point. In the next session, we'll continue working on this. Yeah, we'll deal with the pip size, and we will extrapolate this calculation into different, probably different currencies, because it may change if your currency is not the pair you are traded. So there is another layer of conversion that you have, calculation that you have to add to it in order to fully understand the issue. And the pip value itself, it's not something that is fixed, but it goes up and down with the market price, depending on the pair, or on your base currency or on your account currency. Okay, no problem. We are going to finish here to wrap up. I think we covered exactly what we wanted to cover in this session. Thank you very much for your continued attention, and see you in 2 weeks. Allow me just to give you the link to the next webinar. Is this one? Okay, this is the next webinar in 2 weeks. Yeah, we meet there, and if anything, just drop me an email if you have any questions regarding the material that we are discussing here. And I encourage you to watch the previous sessions, in order to fully understand the current ones and the future ones, and hopefully they transform your trading to something even greater. Thank you very much. Have a nice week. Bye-bye.